This webinar is the first in a series of 6 that I'll be doing to introduce Wyckoff to students that are beginning to understand Wyckoff, as well as those that need a refresher course. I go in more detail in the mentoring section all located on the LTG trading site. But these are intended to give a little introduction to Wyckoff and the reason why I find it to be somewhat of a superior method of looking into trading. There will be a total of 6 of these starter webinars, as well as a point and figure webinar series as well, which will be done by Amos Combs as a CTA. The 6 starting webinars that I will be doing, one will be on the Wyckoff schematic, which you see currently on the screen now. And then the next one will be, then we'll have accumulation, distribution, trading range, springs, and upthrust. These will be a total of 6 of these webinars. They will last anywhere from 60 to 90 minutes. And again, they're intended to be introduction to the beginning of Wyckoff and not to be intended to be the detail which we discuss thoroughly in the one-on-ones, which are unlimited in scope of nature. So let us begin with the schematics. The chart that you see is the Stock Market Institute chart of the Wyckoff wave chart schematic. And in this particular chart, it is taken from the market going from the down phase, the markdown phase, the accumulation phase, and the up phase. We will not go in detail with this chart, this series, this first part, as we will go for detail in the subsequent ones. So, let us begin with our disclaimer. There's a substantial risk of loss in trading commodities, futures, and options. Past performance are not indicative of future results, and the opinions expressed for those of Gary Ford LTG LC are not to be taken as a recommendation to buy or sell commodity future options. This is educational purposes based upon the teachings of Richard D. Wyckoff. We also have a disclaimer on the bottom of the charts, which you should read as well. Okay? So before we begin into this chart, we want to be a situation to where we have 3 Wyckoff principles that cannot be denied. And these 3 Wyckoff principles that we have will be: 1, we will have effort versus result. Okay? I apologize for my writing is not too keen. And this is the effort that we will discuss thoroughly with charts as we go through examples. But simply speaking, the effort versus result is comparing the bar length and the volume associated with that bar length. Number 2, we have a schematic, a principle of cause versus effect. Okay, versus effect. Okay? And simply speaking, the cause versus effect principle, okay, is one in which the longer the particular sideways trading range we go, the larger of the potential move up or down that this occurs. Okay? So, the longer we go sideways, the longer that the potential move is. We measure the move by a point and figure chart that is a guesstimate. An example would be if you have a quarter tank of gas, you can go a certain distance. If you have a full tank of gas, you have the potential of going much further. There's effort versus results. The last principle, and none of these principles that can be denied, is demand versus supply. Okay? And demand versus supply is simply, do we see the larger down bars or the larger up bars. Example of a demand bar would be a wide bar with large volume. So then a supply bar would be a large volume to the downside, and that would be with large volume down. So this would be a supply bar. I'll write S for supply, and I'll write D for demand. We simply judge. Wyckoff was a master of reading the tape, of how markets accepted price or commodities or not accept prices or commodities. And we can see this by the market behavior. Even though Wyckoff was a purely technical trader, he understood the fundamentals of the market. He would rarely go against the fundamentals of the markets. Okay? So with that little background, there is no holy grail in the market. There's a way of looking at markets, but there's no holy grail. There is a lot of risk in trading, and in fact, 90% of people that trade do end up losing money, statistically. What is very important to understand that most traders, in my opinion, have a complete understanding or have an understanding of Wyckoff and the Wyckoff principles, but don't know them by name. Richard Wyckoff did not invent anything. What Richard Wyckoff did was observe the great traders in the early 1900s, basically the Keene, the Rockefellers, the J.P. Morgans, people that you may have heard of, and he followed and he interviewed William Gann and various different people, and he took the market behavior as such. Again, he didn't involve anything. He didn't invent anything. My mistake. One of the things that's extremely important is market observation of market behavior is the key to understanding Wyckoff and Wyckoff principles. Most people don't follow Wyckoff because it takes a lot of work to follow it. They try to look for something, patterns, and Wyckoff is not about patterns. Okay? It is very, very important. It takes a lot of hard work to do it. Okay? So this is something that we must realize. It's something that we must tackle. But it really, in nature, really is logical to think of the markets, and most people want the quick fix of the particular markets. The only two parameters of a market that you can see live are price and volume. Every other indicators that you've seen or looked at or whatever always happens after the market moves, and then somebody does a software program or somebody does a program in which they try to look at the past data and they try to put that in a chart form. Well, Wyckoffs change all the time. Markets change, not Wyckoff, but markets change all the time. So it happened in 1929. Could be a lot different than happens in the year 2014. The problem with people is that they try, since history does repeat each other, the problem is people try to take one particular era and compare it to another. It is true that a chart is a chart is a chart, and we can do Wyckoff on all time frames, but there's always, in human nature, it never changes. But the problem is that what the economic situation or the era situation could be completely different. People's emotions remain the same, remain a constant. The movie Jaws scared people in the 70s. The movie Psycho scared people in the 50s. And there's something today that could scare people in the 21st century. So people's emotions basically are the same. The Rockefellers of the day get transformed maybe to the Buffetts of the day. Okay, so it's a continuous cycle. So Wyckoff's charts work today the same way they worked back then, but you have to realize that nothing is perfect, and most Wyckoff charts are not classical in nature, but we read them the same simply because we understand the nature of the markets. So with the Wyckoff schematic, getting down to brass tacks now, the Wyckoff schematic in this particular chart, we see that the market is starting a down sequence or a down move, okay? And this happens after distribution, but we're going to go full circle on this today, okay? So we see the markdown phase. And in the markdown phase, the market generally goes down after building cause of distribution to go down, and the market just starts its downtrend. And you can see this occurring. What we notice about this Wyckoff wave structure is that as the market goes down, the down waves, or the down bars, and this will all be discussed in future webinars, are greater than the up waves. So we see a market that goes down, may rally, goes down, may rallies, and we understand this as being lower highs and lower lows, so our trend is down. So our trend is down. So we see that, and as long as the market continues to make lower highs and lower lows, the trend remains down. Many people, that is trend. Many people don't understand trend very well because I like to use the term or the sequence of a series of lower highs and lower lows. Because if a market in a downtrend does make a reactionary high that is higher than the previous high, that doesn't mean that the market all of a sudden has broken the downtrend. So in the classical sense, the market will not make higher highs, but there are cases in which a market may go up here, form a higher high, and then break. And this will be a up thrust of the market, and we will discuss this when we discuss the Wyckoff sequence. So not every high has to be lower, and not every low has to be lower, but a series of those. The most important aspect that you will know as a trader is the word trend. If there was one word to describe the success possibility of someone who trades, is that they follow the trend. If there was somebody that just said, what can you one word? The word is trend. Because in trends, since we know that we make lower highs and lower lows in a downtrend, we're always going with the ease of movement of the market. So that's what we want to do. It gives us a higher degree of success than trying to pick bottoms, which is why people mostly lose, because they, in my opinion, they try to pick a bottom because they think the market is cheap enough. Our job is not to determine what is cheap and what is expensive. That's the job of the composite operator or the composite man, in the Wyckoff term of the market, akin to the market. So we are basically looking at a market that has larger down bars than up bars, and the market will continue to go lower. There comes a point in this market in which the market begins to have a first decent sharp rally in that downtrend that has the volume. In this particular case, this would be what we have here. If we have volume, this volume would be somewhat consistent. In the down move, we have a market that now has a rally. In this particular case, this line is a rally, but usually that rally is a little bit sharper than what is shown here, and the volume does increase. Okay, this increasing volume indicates that the composite operator or the composite man is starting to cover or starting to buy back his shorts from the down move. It is the way that the CM, or the composite operator, indicates to other composite operator that the market is soon coming to the end of the down move. By the way, the list of illustrative terms are on the LTG website, so feel free to look at those. The schematic, as you see, was a lecture that I did in Florida, so this is why you see the borders the way you do. Okay, but it was a nice schematic, and it was my discussion with this. So I'm showing you this particular chart as is, but this is taken from the Semi Stock Market Institute sites. Okay, I don't invent anything. I tell the market the way it is. The market then has a preliminary supply. So if this composite operator begins to cover his short position by buying the market, creating that rally, and if he has many shares or many commodity futures to cover, it's almost nearly impossible to cover all of them at the same time, because it would create a tremendous rally. So as the market is going down, it's much easier to buy as people, funds, and specs are selling it to them. At this point, the psychology of the market is bearish, and people think that the market's going much lower because the trend is established, and as the market makes low, that means that the market is weak, and that means that there's more sellers as the market goes lower by the funds and by the specs. That first rally then creates selling at resistance because people follow the trend, and that creates a large move down. This large move down that we have is what we call a selling climax in the market, and usually in classical Wyckoff, this volume is larger than the preliminary support, and the range of the selling climax is wider. You can hear this is a term called capitulation, in which all the shorts are piling on, and all the longs have got blown out of the water due to margin call or because they just can't take it anymore. So that creates a selling climax. It is during this time when the market's sentiment is very bearish. Everyone thinks that the market may go much lower. And since the composite operator created that preliminary support, he then creates the selling climax by buying the contracts that the funds and the specs are selling to him, and he covers the rest of his shorts. By him coming the rest of his short position, by buying them back, this creates something that we term an automatic rally, or AR for short, automatic rally. It is the rally that comes right after the selling climax, and it's the rally that creates the creek area or the resistance area of the market. Now, when we label these things early, we really can't label them until later in the sequence, but as far as this schematic is concerned, I'm going to label them now because I want to show you the particular terminology that happens. It is after this selling climax that creates this automatic rally that generally will rally to the preliminary support high, that creates the creek, is when we begin what we call the left-hand side of the trading range. You consider the left-hand side of this trading range. Here, it's where the cause gets built for the market. Okay? And we talked about the three principles of Wyckoff. These principles cannot be denied in nature. There's only three of them, and the market is at a point to where the market is in a situation to where it creates a range, because now the market has to create more cause. This cause is filling up your tank of gas. It's where the cause builds for the next pending move. The market is usually volatile on the left-hand side of this range, simply because there's sellers that have sold, the buyers that will come in, the composite operator, and there's a battle on the left-hand side of the market of the transfers of risk. It is at the transfers of risk in the left-hand side of the market that the CM, composite operator, is buying the shorts back against the funds and specs selling the market to him. That creates a back and filling situation in which you get this volatility on the left-hand side of the range where the process of cause begins again. And we go sideways. At this point, the sentiment is about as bearish as it can get, and the market is finally turned. Now, the market in a selling climax will turn when the news is bearish. It will not turn when the market is bullish, obviously, because the market needs to bottom on negative news that occurs in the markets. Then we develop this trading range that forms building cause, and I'll label that as TR as trading range. And it's very nondescript to what happens. You'll see high-end closes, you'll see low-end closes, you'll see closes that look bullish and look bearish and everything else. Again, as we go into the sequence of trading ranges, we are going to go in further into this. Right now, I just want to show you the schematic of this. We then all of a sudden retest back to the selling climax, okay, or to the ICE area support. Okay, we call this creek as resistance, where the automatic rally is. ICE is where the market has that selling climax low, and the market trades here. Now, there are several ways that this market can go. We discussed this in the trading range section. It can go all the way down to retest, come halfway back, or it can make a spring of the selling climax. A spring is the penetration of the selling climax low and a close above it. Okay, so in any way, we call this the secondary test. The secondary test in the market. ST for secondary test. It's where the market is building its cause, it's testing. If you notice that they call this creek here, market-wise, in theory, Wyckoff drew it almost these highs, something like this as a creek, something like this as ice, just because he would take the individual lows and he would draw almost where they would connect. In practicality, we draw them as horizontal straight lines. But in the classical world, they almost became like a moving average of the particular index that they were following. There's a certain amount of stocks that Wyckoff followed, and he weighted them. This is why you see them as a market that is wavy on this particular chart. We draw them as straight lines, like they do here. Okay? So, after this secondary test, and the market is nondescript in that range, we get on the right-hand side of this market is where we begin to go after we start the left-hand side. As the market goes forward, we develop the right-hand side of this particular market, and we stay there until there's some type of news or event that allows the market to have a sharp rally in the market, and that sharp rally on the right-hand side is what we term a sign of strength. A sign of strength, or SOS, is characterized by a large move within the trading range that tells the CM that the market is about to be marked up above this automatic rally or creek area. Okay? This sign of strength can happen in two ways. One, within the trading range, or two, as it gets above the trading range. But again, they're both characterized by large volume and large bar range. It could be several bars, it could be one bar. Okay? It is at this point the sign of strength that occurs. We can label this with certainty. Until we get that sign of strength bar, we cannot label it as a selling climax sequence until we get the sign of strength. Since this is labeled this way already, I just wanted to give everybody a disclaimer of what we need to see. Okay? Once we build this cause, and once the market has particular news or some event to take it and have that sign of strength, we are ready to ultimately begin the mark-up phase of this particular market. Okay? So, once we have that sign of strength, we now have a change of behavior from a downtrend into an uptrend, or in a trend. Now, you can look at this chart, you can see that to a technician, the market has a long way really to go to start to make a series of higher highs and higher lows. But to a Wyckoff student, once that sign of strength is confirmed, then we have the permission to buy the market at support with the appropriate stops. Not until then. Okay? If this market gets above this resistance area, we call creek, and then dips back into the range, the market should not classically go more than halfway in the range, and then the market will mark up again past that creek area or resistance area. We call this LPS, or the last point of support. It is the last retest of the market, checking to see if there's any supply in the market. And if we had a sign of strength, there should not be any supply in the market. That market should be bought by the composite operator because he buys breaks to defend support, which creates a rally by his buying. And this could be to jump over the creek again with the sign of strength, and the market goes to its markup phase. So that is a sequence of the accumulation process of the Wyckoff schematic in part 1 of this particular chart. So everything that I say that occurs in one section of a market that's bottoming out is also true on the downside of a market that is topping out. Okay? So that is a true statement of both things that occur. Sometimes we use different terminology for that, but the market works the same structure from the standpoint of bullishness and bearishness the same way. So this particular chart shows the market bottoming out, where it's coming from the down phase, the first rally, the selling climax. How many times can a market test the low and be considered, how long, days, weeks, hours, months, years? They're all true. Markets do this intraday on small time frames. They also do these charts in the long term, your monthlies and your yearly charts. What we do know is the longer the sideways, as I said, the larger the potential move, and we figure that out by point figure. This is why point figure chart is being considered as part of the starter series in beginning this. Again, not going into great detail, because there's much more to it than just looking at this classical schematic, but it'll give us an understanding of what happens to people's emotions and why things occur the way they do. And the market begins to mark up. We see, in the tape reading wise, we see that the market has wider up moves than they do down moves. And the market moves up in a fashion opposite of this. Okay? Now, in each one of these phases here, as well as here, we do develop sideways trading ranges that build more cause. In the schematic chart, it shows the market going straight up to a point to where it's going to come to a top, or straight down to where the market is going to come to a bottom. As the market moves up in nature, the news becomes more bullish, which takes funds and specs as they buy new highs. The CM who bought the market in this accumulation phase down here, which will be discussed later, he is riding the wave of the funds and specs are buying the market. He will allow this wave to occur until he finds that the market is to a point where it's becoming overbought, or where the market has value that is too high. And then he will step in to the market and he will begin to sell his longs, and the process to the downside begins. So if we go back and look at this chart, the standpoint here, we see the market is going down. We see the market comes to some type of value to the composite operator because they start to cover their short in the market, feeling that the bottom is nearby, and the market will create some type of trading range that will occur, and the market will have the ultimate markup phase. The markup phase can only occur after we have a sign of strength in the market. If we do not have a sign of strength in the market, then this market will continue to go lower. For the practicality of the webinar, we're assuming that the market is labeled the way it's labeled. I'm just trying to point out what the Wyckoff schematic represents. This is all very, very important, and we know that the market could go higher as long as the market does not encounter the preliminary supply aspect of the market, which we're going to discuss next. But this market, we know, is turned and has a change of behavior once the sign of strength is realized in the markets. You can see in here in the Wyckoff schematic, the A represents the markdown phase, the B represents the cause building phase, the C represents the secondary test that occurs here, the D section is where the market gets above the creek or resistance area and falls back in it, and the E market is on the right-hand side of the Markov phase. So the left-hand side, again, occurs when we see the first decent rally from some type of low, and the market then forms a trading range. Once that market forms that trading range, then we have the left-hand side developed, and then the market will go sideways, build cause. Okay. One of the things that you must remember, you must keep at your desk, or keep in your head, is the fact that the three principles, once you master those three principles, you'll have a decent degree of being successful. Unfortunately, most people don't master them, and it hurts their operation. But from the standpoint of markets, the accumulation phase or the sideways behavior occurs after, it occurs, but it's only a situation to where it's confirmed by the sign of strength. The sign of strength is needed because the sign of strength means that demand is overcoming supply. As you see the market is going down, supply is overcoming demand, and we know the market trend will continue lower. We need to see demand overcoming supply to turn the market up, and we will see that with the sign of strength bar. Okay? We'll see that with the sign of strength bar. There are several. There's a buying bar where a market will just do this with decent volume. We will see a demand bar, the degree, larger range, larger volume, and then we'll see a sign of strength bar, that will occur only on the right-hand side of the trading range. Only on the right-hand side of the trading range. It's a specific demand bar that is wider in range, larger in nature, that occurs only on the right-hand side of the market. Only on the right-hand side of the market. You do not get a sign of strength on the left-hand side of the trading range because the market is not going through the sideways accumulation phase to qualify for a sign of strength in the market. So until we see that sign of strength in the market, we do not have a change of behavior in the market. That is a very critical and a point where most people in Wyckoff or trading-wise don't understand, and they think that the market has some type of demand rally, and they think that's a sign of strength. And they go in and buy the market only for the market to make new lows. That is not proper. That is incorrect way of thinking. So that concludes the first portion of the market of the Wyckoff schematic of the bottoming section of this particular chart. We now have a chart that has the opposite, where the market begins the down phase. So, where I left you before is the market was going through this markup phase in this last chart. We will continue to go higher. Okay? The first break in the market, the first break in the market that has large volume and large range down is what we call PSY, or preliminary support. It is the opposite of preliminary supply. It is a market that gets the first decent selling by the composite operator who decides that the market has gone up enough, or the market begins to become overvalued, and he begins to unload the long position that he did during that trading range that we discussed earlier in the market. Okay. The market then continues to go up. The market continues to go through. People are bullish. They tend to buy this particular break. They're buying support because they feel that the market now has gotten to the point to where, since the trend is up, they're going to look. The traders are going to look to buy the support. Again, the CM cannot sell the markets. I mean, the CM sells the market as the funds and specs are bidding prices up. That's where he gets top dollar for his operation, because this begins a phase in which now he says maybe too far, too fast, or maybe feels that something is fully valued. If you look at things that you buy yourself, you will tolerate certain price increases for a while till you reject them. You may have no problem with gas being $3 a gallon, $4 a gallon. If gas gets to be $5 a gallon, it may not be very cost prohibitive for you to buy gas. You may want to drive less. You may make major changes. So there's a certain time where maybe the market prices out people, or it gets too extravagant to one way or the other. So everything you do, you put a value on yourself, because what you do is that you refuse to buy something that is too expensive. So you're putting a value on what you feel that the market is worth to you or is not worth to you. If the market gets too highly priced and it's not worth it to you, you'll stop to buy it. You won't buy that particular product. You may like steak, and you don't mind spending $10 for a nice piece of steak. The price of steak goes up to $17. Even though you may like steak, that doesn't mean that you're going to pay $17 for steak that you paid $10 with last month. The same thing with markets. Then they go up. Again, when we start to see this market, the buying climax has a situation. The market has a situation in which the market will continue up until it gets that preliminary supply. That's what we bought. That creates the buying climax. Again, we label this buying climax after we see the sign of weakness on the right-hand side. But for the practical purposes now, we do not have to do that. And we now see that the market is at a point to where it has large range, large volume on the high, which we call our buying climax. Large range. Let me just try this drawing so we're not confusing ourselves. You have a situation where you have preliminary supply with decent volume. You'll continue to go higher. You'll have what's called a buying climax. Market will go higher, finish poorly with very large volume. That will be considered the buying climax after we see the sign of weakness at the trading range. In this case, so the buying climax has more volume and more price range, just like the preliminary supply. Just like for the preliminary support, and market-wise, we saw large volume, large barrel, but pales compared to the selling climax. Even though I'm talking theory in this first lecture, we will show this with charts as we go further into the series. So I'm trying to give a basic general overall view of what it would look like. At the buying climax area, you will see that the news is very bullish. You will see that even the shoe shine boy will say, boy, this market is going up. Think of the .com era, 2000. Everyone was buying stock that had no earnings to them. They were buying all these stocks that basically may not be around the next day, and around to the world and things of that nature. There's this speculative fervor that occurs in the market, where the market is just being bought and bought and bought with reckless abandon to price. The opposite is true on the downside. It's being sold because they don't care at the prices. They want to be out. In the case of the markup phase, they want to buy particular stocks because they think the stocks are going to the moon. And some stocks are going much higher. After this buying climax occurs, we begin at the left-hand side. It's a term that we're going to get very familiar with. So on the left-hand side, it's characterized by this large volume that occurs in the market, the large volume that occurs in the market with the large range, and it begins a battle between the specs and the CM. The transfer risk occurs at that level as well, and the market goes sideways and will develop that cause, just like this market caused that, because none of the market was sideways before, because the market had to build the particular cause to the market. Again, a quarter tank of gas will not go as far as a full tank, so the smaller the trading range, the less of the move the market occur. The longer the trading range, the larger the potential of the move can be. Point figure charting to calculate this is very time consuming. It's part of Wyckoff and should be learned, but most people don't have the drive to try to do point and figure chart as well. Back in the 80s, we used to do that by hand. It took an enormous amount of time. So now you get a lot of software programs that will tend to do that as far as that's concerned. So we don't need that. Just like Wyckoff during the time he had the old black book and the bucket shop type of thing. Now they got sophisticated platforms and speed trading and all things of that nature, right? So the news on the buying climax is bullish. The news on the preliminary supply here is also bullish, but more bullish on the buying climax. Then the market forms this particular trade range. We discussed what this phase were. It forms some particular trading range in the market, sideways action, and then we see a market that tries to hold that little support area, and it has a weak rally, indicating that the market has shown less volume and less price range. In the market also then, on the right-hand side again, we get our sign of weakness that would occur. This sign of weakness that occur. It's the first sharp break on the right-hand side of the trade range after the distribution phase. Okay, market has a rally. We are building cause, has a weak rally, and then we have, in this particular case, we have this markdown phase, and this occurs. We'll discuss when we test back to here again in following lectures to go. But in this particular case, the market's making lower highs and lower lows. The market has more volume to the downside than to the upside for the most part, and the volume is increasing, or market is steady to fairly high as the market breaks, as the longs are getting out, and the CM is marking down the prices of the market. This process will continue until the CM finds that value, which take you back to schematic 1. Again, within the trading range, the volume could be heavy, the volume could be light, the ranges could be small, the ranges could be large, the volume could be high, and the volume could be low. It's basically the market is jockeying for position for the next particular move into the markets. Most markets, maybe 70% of the time, will stay in trade ranges. So to master the trade range, which we're going to lecture on, master the trade range is one of the most important aspects of things that you can do. If you can identify this particular trading range, if it's going up or going down, then you have something very, very valuable. So you have something very variable. So again, terminology, some of the words is different. Preliminary supply versus preliminary support, buying climax versus selling climax, and all of those nature. But having said all that, simply that the market will go up and will go down, and the market will form some type of range, and then the market will give you a sign of strength or a sign of weakness on the right-hand side of the trading range. That's the tip-off to you from the CM, saying that the market is ready to have a change of behavior in the market, of a change in behavior in the market. Okay? Even though Wyckoff, the market could be still making lower highs, ultimately it's in that sign of strength, the market will take that out. Okay? So that is something that's very important. Then the market goes to the markdown phase, and will end with the preliminary support that occurs in the market. So that is basically the Wyckoff schematic, how it works. In between these areas that you see, for example here, this may form a trade range to go down. Doesn't necessarily mean it has to go straight down. Okay? But from the schematic standpoint, that's exactly what they show you, that the market just goes to the markup phase and the markdown phase. Not everything, as I said, is classical Wyckoff. Sometimes you need to read into it from the standpoint of what really demand, what really supply is, in the various different ways of how the market is accepting prices. And that's basically what trading is. Is the market running away from price, or is the market not running away from price? If it runs away from price, things may be too expensive or too cheap. If it doesn't run away from price, then that means that the market's fairly valued to where the market is. Very important to understand that. Again, markets mostly are in trade ranges, so to identify the trade range of the market, they will give you a tremendous amount of edge to the market as the market goes through the back and filling stages, or the up and down stage in the market, from the standpoint of building costs for the next pending move. So this concludes the first Wyckoff schematic section lecture that we did. There will be obviously 5 others to follow, but this is the first lecture on the schematic of the bottoming process, as well as the schematic on the top side for the distribution phase of the markets. Okay. So this concludes lecture 1, and I wish everybody a good day.